Hello, I'm Udayan Mukherjee, and today I'm going to talk about the price earnings multiple and why the PE ratio is an important tool in the hands of the investor in determining whether you're paying more or less for the share that you're looking to buy. It's not about how good the company is or how bad the company is. That's a different set of research which you would have done already. Having done that and having decided that you're going to buy this company X, you want to know whether you are paying enough for it, whether you're getting it cheap or it's too expensive, you're paying too much for it. And in that, the P multiple is not the only, but one of the most powerful tools in determining whether you're paying the right price for the stock that you have chosen. So let's start from the top. What is a PE multiple? As the name suggests, it's a price to earnings multiple. So you take the market price and you divide it by the earnings per share. So the key thing to arrive at is the EPS of a company, the earnings per share, which is very simple. You take the profits of a company and you divide it by the number of shares the company has. So if a company makes profits of say 100 crores in a year and its share capital is 5 crore shares, then you just divide 100 crores by 5 crores and you arrive at a number of 20. Therefore 20 is the earnings per share of the company. Now let's say the company's share price, the company that you're willing to buy or looking to buy, is 500 rupees. And your earnings per share which you have calculated is 20. So you take 500 and you divide it by 20 and you get 25, which is your PE multiple. Simple so far. The share price of the company divided by the earnings per share which you have calculated, and that price divided by the earnings per share is your PE multiple. That's simple. It's very easy to arrive at that number. But you can easily ask, what profits shall I take? Because sometimes I hear 1 year forward PE, 2 year forward PE, and there is a current PE. So that brings us to the very important point of trailing PE multiples versus forward PE multiples. What is the trailing PE multiple? Say you're sitting in April of a current year, of any year, and results of a company have just been declared, which is the previous financial year ending in 31st March, April of which you are sitting in. So you have the last 12 months profits which have just been declared. You take that and you arrive at an earnings per share and use that to calculate your PE multiple, and that's called the trailing PE multiple, which is a PE multiple based on the actual profits of the company of the last 12 months. And that in a sense is a very good yardstick to go by because it is a real profit PE multiple. However, there are often a lot of people who do not look at the trailing multiple because the markets are forward looking. Markets always want to know what lies ahead, what's in the coming year, and therefore they say if last year's profits were 200 and I expect next year's profits to be 250 crores, it's an expectation, it's not a real profit, but they take the 250 crore expected profit number and calculate the earnings per share, and on that basis the PE multiple is calculated, and the PE multiple usually tends to be a little lower because profits go up and therefore the PE multiple looks a little lower. So that's the 1 year forward PE. Well, sitting in April, you're calculating the PE multiple based on the expected profits of the next April, the April of next year, and therefore it's a 1 year forward. The 1 year forward PE multiple is usually the most commonly used PE multiple, though it can often go wrong because companies may not declare profits along expected lines. So that risk is always there in calculating the forward PE. Now, you can easily ask, why do some companies have high PE multiples while other companies have low PE multiples? This is a very important question because the PE multiple which the markets ascribe to any company is a fine art. There is no thumb rule to it that company X belonging to this sector will always have a 20 PE or 25 PE or 15 PE. It's not like that. The PE multiple keeps changing around with the stock price. And usually companies which have very high growth, which has demonstrated high growth consistently in the past, growth in profits, they tend to get high PE multiples from the market. So you will find that companies like Infosys or Hindustan Lever or Asian Paints generally tend to have higher PE multiples because they have a consistent track record of delivering profits in the past, and therefore the stock market in its wisdom gives these kind of companies, which are high growth companies, a high PE multiple. And therefore it's important to know what is the sector average PE multiple, because different sectors have different PE multiples, which are called the industry PE averages, and they tend to vary quite widely. Just as we have discussed high PE multiples, we can also talk about low PE multiples. What are low PE multiple industries? Industries which are very cyclical in nature, where the profits keep going up and down. And the classic example is something like metals. In a good cycle where metal prices are going higher, metal companies make a lot of profit. And that may be for 3-4 years on the trot. And then when the metal cycle turns down, these companies don't make profits, and therefore their stocks start to come down. So such cyclical industries where profits are good in some years and profits are very bad, sometimes even loss-making in many years, they tend to have low PE multiples. Another example is public sector companies, where the market is never very confident about the quality of management, and they tend to be lower growth and lower corporate governance companies, and therefore the PE multiples are quite low. So when determining the PE multiple of a company, to ascertain whether you're paying more or less for a company, always keep the industry PE multiple in mind so that you don't get misled. So you can ask, what is the ideal PE for a stock? There is no ideal PE for a stock. It depends very much on the nature of the company and very much on the nature of the industry it belongs to. But ideally, investors should say that if they can find companies which are not above 20 PE, then for growth companies, then they are not overpaying too much. But sometimes PE multiples can be 50, 40, 60 as well. So there is no hard and fast rule, but the higher the PE ratio, the more you're paying for the company. The more the number of years of profit are built into the stock price, and therefore your risks are higher. So what about the market? People keep saying the market is expensive or the market is cheap. Going by our past history, the Sensex and Nifty, the average PE multiple would be something like 14 and 15, average. And therefore, anything less than 15 PE, I'm of course oversimplifying, but anything less than 15 PE is considered an inexpensive entry point into the market. So you buy when the market is trading at 13 PE or 14 PE, chances are you will make money. The more you go above 15, say you go to 20 PE and higher, then the market is looking very expensive or quite expensive. That doesn't mean that the market will fall immediately, just that you're paying more than the average for buying and getting into that market, and therefore your risks are higher. So thumb rule, above 20, probably expensive market, below 15, probably attractive market, around 14, 15, 16, average, and therefore your returns should be around the long-term average for the market. Now, all of this is a simplification, and the PE multiple is not the only metric which helps you evaluate whether a company is expensive or cheap, but it is usually a good yardstick to go by, though in companies like banks, banking stocks, the price to book multiple is a far more efficient way of looking at it, but the price to book we can talk about in another day. But I hope this was useful in determining what is a PE multiple and whether it comes in handy to you while evaluating whether you should go ahead and buy the stock that you've chosen.
If you like the video, do like, comment, share and subscribe.